Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith. Let's get to the three things that you need to know today. First up, U.S. stock futures, little change this morning as investors await the Federal Reserve's rate decision. Traders are counting on Fed Chair Jerome Powell to give a sense today of how soon the central bank will cut interest rates. The worst case outcome for the stock market would be if he pushes back on expectations for cuts in the fall. Yahoo Finance will bring you full coverage of the decision and Chair Powell's press conference beginning at 2:30 p.m. Eastern Time. Our coverage begins at 2 p.m. Eastern Time. Plus, tensions are flaring between the U.S. and Iran. Iran threatening the U.S. with irreparable damage if Washington follows through with a military strike against the country. The threats come just a day after President Trump called for the unconditional surrender of Iran, warning that patience with the country was wearing thin. And a major legislative win for the crypto industry. The U.S. Senate has passed stablecoin legislation that sets up regulatory rules for cryptocurrencies pegged to the dollar. It's widely seen as a landmark win for the crypto industry and for Trump. Crypto stocks are moving on the back of the decision, with stablecoin issuer Circle rising in pre-market trading. We're counting down to the Federal Reserve's interest rate decision due out 2 p.m. Eastern Time today. The Fed expected to hold rates steady despite pressure to cut from President Trump. Yahoo Finance's Jennifer Schonberger has more on what to expect. Jennifer, what are you looking forward to here?
Good morning, Brad. And the Federal Reserve just kicked off the second day of their two-day policy meeting moments ago here in Washington, where they're widely expected to hold rates steady in the range of 4.25% to 4.5% for the fourth meeting in a row. All eyes, however, will be on whether the Fed still sees two rate cuts this year. And at the heart of this really lies just how much inflation the Fed sees ahead. Back in March, the Fed saw inflation rising to 2.8% this year from 2.5% projected back in December. Some economists expect that will be ratcheted higher this afternoon. But inflation in April, as measured by the Fed's preferred inflation index, the Personal Consumption Expenditures Index, clocked in at 2.1%, practically at the Fed's 2% goal. And adjusting for volatile food and energy prices, inflation rose 2.5%, dropping from March. And in May, the Consumer Price Index also showed a mild reading on inflation. So why then, when tariffs had kicked in full blast starting in April and inflation basically hit their 2% goal, is the Fed holding rates steady in the range of 4.25% to 4.5%? Well, it's the risk that tariffs pose ahead and the uncertainty around that. Will tariffs lead to higher inflation or not? 2 months is not likely enough for the Fed to tell. Minutes from the Fed's last policy meeting showed almost all Fed officials expected inflation from tariffs to be longer lasting. But we're also constantly seeing the chance for changes to tariffs. For instance, this week with Canada and the U.S. working to potentially eliminate steel and aluminum tariffs. On the flip side, will lower growth ensue instead because consumers can't swallow higher prices if they occur? Fed Chair Jay Powell and the Fed are likely to continue that wait-and-see approach. That's why many think it's likely they will actually keep two rate cuts for this year. They don't want to change much when the outlook is changing so much, and they're just unsure. Brad?
Jennifer, we also know what's playing out in the Middle East and that conflict. How does that factor into the Fed's outlook, and what are we expecting to hear?
They are certainly going to be watching what's going on in the Middle East closely, particularly as it pertains to oil prices. But at this juncture, Brad, I just wouldn't expect them to actually integrate any of that into their actual outlooks for inflation and growth. However, if we do see things worsen, if oil facilities were to be struck and that caused a spike in oil prices, then certainly that may be taken into consideration.
Thank you so much, Jennifer. Everyone can stay with Yahoo Finance all day for more coverage on the Fed. We'll bring you the decision live, 2 p.m. Eastern when it crosses, followed by Fed Chair Jerome Powell's press conference at 2:30 p.m. Eastern Time. The Fed is expected to keep rates higher for longer as its June meeting wraps up later today. All eyes will be on the commentary from Fed Chair Jay Powell and what he signals for the rest of the year. Joining me now, we've got Brian Railing, who is the Wells Fargo head of global fixed income strategy. What do you expect the tenor to be from Fed Chair Powell today?
Well, I really expect the tenor to be rather neutral. I don't think the Fed is going to make a big push here either way. They're really in wait and see mode. So I'm not expecting any surprises.
So what does a neutral tenor mean for fixed income strategy as it pertains to people's portfolios?
Well, for the time being, the 10-year yields are really kind of trading in a fairly tight range around that 240 level. I don't see any big change to that. A couple of things I would watch for, though, as the big, beautiful bill makes its way through Washington, the amount of stimulus that could potentially push the longer-term rates a little higher. That's maybe a little bit more consequential than what the Fed is doing today, which is, again, largely expected to be, a neutral, a more non-event. So those are the kind of things I'd be watching. Also kind of risk on, risk off in the markets. We still have that negative correlation between stocks and bonds that can push yields around.
And so with that in mind, what are you seeing in terms of the appetite for duration right now among investors and after we've moved through the auctions that took place last week?
Yeah, I think largely, there's not a lot of investors going out there adding a lot of duration, especially at these levels. The 10-year, again, down below that 440 level doesn't make a whole lot of sense unless you think that the economy is going to really slow more dramatically. Then you would, of course, think about adding duration. To me, there's just too many risks out there, both with fiscal stimulus making its way through Washington and also with kind of the tariff uncertainty and how inflation might manifest itself later this year. I just don't think it's a good time to get stuck long duration.
I was taking a look at one of the notes recently. I think it was within the past week here, June 13th, from Torsten Slok, talking about the Apollo chief economist, talking about record high foreign exposure to U.S. duration in Treasury markets. How should investors be thinking through that international interest and demand for the longer end of the scale?
Yeah, again, I'd be kind of careful on the longer end. Foreign demand, I'm not sure it's as strong as, that the U.S. would like. You have rates really around the curve, or, that long end around the globe kind of pushing a little bit higher. It's not just here in the U.S., but in Japan, elsewhere. So again, unless you really think the kind of global economy is going to go into more of a tailspin, I just don't think that, buying a lot of duration here makes a lot of sense for most investors. And
so where else should investors be looking to get some of this exposure internationally as well? Is there a better market or bond opportunity in some of the international markets, especially as we're hearing about this diversification strategy that is looking towards offsetting some of the U.S. exposure with international exposure from investment strategists?
I don't think so. I still prefer the U.S. The U.S., do we have our challenges? Yes. But, the rest of the globe is in a similar situation, if not some cases worse. And we have better yields here in the U.S. So to me, especially for U.S.-based investors, it doesn't make a whole lot of sense to go get that foreign exposure. And then also often you are exposed to the currency risk as well, unless you hedge that out. So to me, most investors probably better off just maintaining that U.S. Focus.
Is there a risk that the bond markets could be shocked if we didn't get 50 basis points worth of cuts that is currently priced in by the end of the year?
Oh, I don't think so. I kind of, again, we're only expecting one rate cut actually between now and the end of the year. I think there's kind of two scenarios if you think of the tails that could play out. Either the economy starts to weaken a lot more than expected, in which case the Fed is going to have to come in and cut much more than those two times and likely see rates, of course, across the curve move lower. Or the other tail that I think you have to concern yourself with is that the economy hangs in there and we start to see inflation start to begin to move higher as kind of that tariff effect really starts to hit. And, the Fed may not cut at all, in which case, there's real potential for upside in rates, especially with the fiscal stimulus moving through Washington. So, I think investors have to be aware that there's these two potential outcomes. And to me, kind of where we're sitting now in terms of rates, I wouldn't be taking a big bet either way.
Brian, good to see you this morning. Thanks so much for the time and insights.
Thanks.
Israel and Iran are trading strikes for a sixth day as Iran's supreme leader rejected President Trump's calls for surrender, adding that U.S. involvement would result in irreparable damage. Joining me now to discuss, we've got Evelyn Farcus, who served as the executive director of the Commission on the Prevention of Weapons of Mass Destruction, Proliferation, and Terrorism under the Obama administration. She's currently the executive director of the McCain Institute at Arizona State University. Evelyn, thank you so much for taking the time here with us.
Thank you. Actually, I should say it was under President Bush, but then in the transition. So it sort of went through a transition time.
You saw the changing of the guards and quite a time, I'm sure, in really working across those administrations and trying to make sure that there was a clear handing off of the baton. As you think about what we've seen play out thus far, what would have been on your checklist, or at least the kind of triage mind frame for you and your team?
Yeah, I mean, essentially, the question is always, what's the risk of the nuclear program? And at this point in time, Iran's nuclear program is set back significantly. So it's not an immediate risk. It is, of course, a huge potential risk, and we want to eliminate it from the playing field geostrategically. The question is whether it gets eliminated using military force or diplomacy or a combination of the two.
And so with that in mind, what is the likelihood that we do see a nuclear deal even start to get discussed, especially knowing that we're in more of a hot head scenario versus a cooler heads prevailing type of point in the chronological order of all of this play out?
Yeah, I mean, I think that it's not helpful to call for unconditional surrender. That just gets into the Iranian regime's, pride. Essentially, it's very hard for any leader to respond positively or respond with an openness to diplomacy when they're being asked to surrender. So though that kind of language isn't helpful, it is helpful, however, that, there is a threat. First of all, military force is being used against Iran, and there's a threat of U.S. military force. That is helpful to diplomacy. That is a threat that our president could use to get the Iranians to the table. But again, one has to be careful of what language we use now, because we want the Iranians to not feel that their pride is being wounded if they go to the negotiating table. It's in the interest of Iran also to negotiate an end to the current situation. If
we did see negotiations prevail and ultimately some type of deal come forward, what would the follow through of that on the other side be like in policing that there is actual good faith negotiation and then execution on the other side?
Well, that's the thing. This is the irony, because, of course, President Obama did negotiate. It was not a perfect agreement by any stretch of the imagination. It was limited to the nuclear threat that Iran poses, and many people thought it should have been expanded to include missiles, myself included there. And then other people thought it should have been expanded even to consider their sponsor of terrorist organizations like Hamas, Hezbollah, and the Houthis. But in any event, it did manage to freeze Iran's nuclear ambition, the nuclear program, because inspections were included as part of that deal. And so, but when President Trump came into office, President Trump said he didn't like this deal and he scrapped it. And as a result, we are where we are today, essentially back in the same position. We need to freeze their program. Yes, it looks like it's mostly destroyed, but of course they have the capacity. Iran has the know-how and the capability to rebuild it. So we need to have another deal and then inspections, just as we had under the deal that President Obama negotiated.
Do you think it's too late for a diplomatic solution here? And what would it look like if the U.S. did get involved?
Well, it's never too late for a diplomatic solution, and this is really the moment. I would hope that the White House understands they have maximum leverage right now, and they should push for a negotiated solution. Yes, of course, the United States could get involved and take out, Iran's nuclear program once and for all. But there is risk that that would cause Iran to retaliate against the United States. I don't have the intelligence on the capability in order to be able to assess that for you and the viewers right now. So I hope our government is assessing that closely. There again, the benefit is we take out their nuclear program for once and for all with our big bunker buster. But on the flip side is, can Iran strike U.S. military facilities? We read in the press that they can still. Can Iran hurt American citizens, take hostages? We know from history that they have done that, and they probably still have that capability. So all of these things need to be assessed right now very carefully.
It's very much, of course, a repeat of the first Trump administration in the framework of mind that it is a very social media forward type of kind of mouthpiece that we're hearing from with the president. What is the significance of that as we are seeing these developments rapidly take place, and how critical does that make even this next 24-hour period?
All of this social media posturing is incredibly unhelpful. I already mentioned that it's unhelpful to ask a government to publicly to ask them to unconditionally surrender, even in the context of Russia, Ukraine, where Russia is clearly the aggressor and has committed all these human rights violations, violated the UN Charter, etc. Even there, we don't call for unconditional surrender. That's some tough language when you want to ultimately negotiate an end to the situation. The other problem is, if you want to distance the United States and allow us some more maneuver space diplomatically, it would be wiser to say, look, Israel is conducting this military operation, and the United States is going to step in to resolve it diplomatically. And so therefore, if we can distance ourselves, unfortunately, it sounds like there's a use of the word "we" by the White House, and that's not helpful either, because it removes some leverage that the president could have, some negotiating ability, some maneuverability.
Evelyn, thanks so much for taking the time, breaking this down, and walking us through, of course, your own experience and how that would have been dealt with in the past and what we can watch for over these coming hours and days. We appreciate it.
Thanks for the opportunity.
Some breaking news crossing the wire. After 18 months of negotiating, U.S. Steel and Nippon Steel have closed their $14 billion deal. The American and Japanese steel makers announcing the news in a statement today. Nippon Steel and U.S. Steel reached a conditional deal with the Trump administration last week that allowed the companies to close their deal, first announced in December 2023, after the Japanese steelmaker agreed to invest an additional $11 billion in the Pittsburgh-based producer. The $55 per share cash deal creates the world's second largest steelmaker and turns the combined entity into a formidable competitor with the American steel industry. Nippon Steel also gets an important foothold in the U.S. that helps avoid U.S. President Donald Trump's 50% steel tariffs. The New York Stock Exchange halted trading of U.S. Steel shares earlier today, noting that the acquisition was effective. We've got all your markets action ahead. Stay tuned. You're watching The Morning Brief. Now time for some of today's trending tickers. We are watching Meta, social media stocks, and names in the crypto space. Yahoo Finance's Josh Schaefer here to help me break them down a little bit more and do a deep dive on some of them. First up here, we got to set the stage and talk about OpenAI's Sam Altman saying that Meta is offering $100 million bonuses to OpenAI staff in an attempt to build up Meta's talent pool. The Facebook parent company getting more aggressive in attempts to improve its own artificial intelligence offerings. Meta reportedly delaying the rollout of its latest AI model because of concerns around quality, and CNBC also reporting that Zuckerberg is frustrated with Meta's standing in big tech's AI race. This comes as Meta announcing it will pay $14 billion for 49% stake in Scale AI as well.
Brad, $100 million bonuses? I feel like we got to just press pause on that for a second. That's a pretty significant bonus.
It makes you want to go on Udemy and start to take some quick coding classes or whatever you need necessary to qualify for this.
You and I are big sports fans, and even someone like Patrick Mahomes, I don't think is barely getting a $100 million signing bonus, right? It's pretty shocking. But I think it gives you an idea, obviously, of what you were just hinting at of where Meta feels like they're at here and maybe needing to do a little bit more. Interesting to me because Meta is one of the few companies on earnings calls that has been able to show how AI is helping their business, platforms, right? When you think about something like what they're doing with Reels, how AI is playing a role in that. But this seems to be going for people from OpenAI, it seems to be more of that large language model play and doing something a little bit different and more targeted closer to what OpenAI is doing, not necessarily just using AI in sort of the AI use case space, but Meta trying to be an industry leader in that large language model part of the AI story.
Yeah, it seemed like he made this acknowledgement on the Uncapped podcast, which is hosted by his brother, we should note. Also here, it's interesting, this has been quite the week for OpenAI and getting some of their own major agreements here. Of course, talking through some of the most recent developments here. They've got their first partnership with OpenAI and the government initiative, a pilot program with the U.S. Department of Defense. It's a massive move forward for them, and the Chief Digital and Artificial Intelligence Office contract is worth about $200 million in the ceiling price for it. And essentially, this is going to allow the Defense Department to identify and prototype frontier AI and how that can transform its own administrative operations. And so we'll see exactly what that looks like in practice. But this is a major step forward for OpenAI and an acknowledgement of the power that they do have behind their engine.
I'm taking a look at our private market data that we have now on Yahoo Finance. OpenAI's estimated valuation per our data, $324 billion.
Yes.
If that company ever comes public, it might be the biggest IPO ever, Brad.
It could potentially be in the throes of it, yes, for sure. I'm old enough to remember when Saudi Aramco went public. That was a pretty large one, too. Next up, we're checking out shares of social media stocks as President Trump set to delay TikTok's divest or ban deadline by another 90 days here. The White House confirming that the president will sign an executive order this week extending the deadline, granting the administration more time to close the deal and keep TikTok working in the U.S. This would mark the president's third extension of the ban, which requires TikTok's Chinese parent company sell off the U.S. version of the app. There you're taking a look at some of the social media stocks on the move here pre-market. And of course, it is one big pull for some of the advertising dollars that would go to TikTok versus a Meta versus Snap versus Pinterest and how they all battle for those dollars. And ultimately for TikTok, they've been able to quickly grow out their user base, make sure that they're also wooing some of those advertising dollars, and how they're doing so is also making for a very competitive threat.
It's starting to feel like this ban just isn't going to happen, right? It just, when things continuously get pushed back, I just start to lose a little bit of confidence.
It's such a pawn as part of the geopolitical discussions.
Right, exactly, right? And that's why it keeps coming up. I think when we're talking about those social media stocks, I mean, the most interesting one to me is Snap, right? Just thinking about how Snap has performed as a stock over the last couple of years. I mean, it's down 25% year to date, down almost 50% over the last year. Snap needs some help, right, to bring in more users and drive future growth. And Meta has still been successful with the rise of TikTok, right? I don't think people have an issue necessarily with where Instagram is at and what Meta is doing with some of their social platforms. Right. But Snap could use the boost. And so that's sort of the stock to watch for me as this continues and if we ever do actually get any form of a ban.
Yeah, Snap, for their own defense here, the brand of Ghostface Chilla, they said that their community grew to 460 million daily active users, an increase of 38 million year over year in the most recent quarter in Q1 here. Q1 revenue increased 14% year over year, 1.36 billion, and it really comes back to some of the direct response advertising, DR advertising, as they talk about it on the call. We got to get to this last one here as well. Finally, the Senate passing the Genius stablecoin bill and sending it to the House in a big legislative step for the crypto industry. The bill largely requires stablecoin issuers align with the same regulations that TradFi, traditional financial institutions, must follow. A broader bill that currently sits in the House called the Clarity Act, seeking to regulate the crypto market as a whole here. There you're taking a look at Coinbase, Robinhood, and Circle on the move to the upside on this passage here for the Genius bill.
Another headline that makes Circle stock go up, right?
Yes.
It feels like that stock has gone up almost every day since it's IPO'd a few weeks ago.
Feels like it.
But the stablecoin conversation feels like it's really starting to heat up right now, doesn't it? I was talking to Julie Hyman about this last week, and just we get in these moments where everyone needs to have a coin, or everyone needs to have a stable coin, or everyone needs to have their AI strategy.
Right.
And when you think about the report last week of Walmart and Amazon starting to look into this, I just wonder how that conversation grows as this act continues to work its way through the House, right? How does that conversation grow to how many companies are going to try and deploy some version of a stablecoin strategy?
Yeah.
And is that report that we got last week about Walmart and Amazon, was that they're looking into it, or how seriously are they looking into it? And are you and I going to need to get Amazon stablecoin at some point to use Prime?
Look, all we've been discussing in our morning meetings and afternoon meeting yesterday was that this might say, or might make Meta say, hey, hold my beer, Diem's coming back. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We've got all your markets action straight ahead. Stay tuned, you're watching Morning Brief. There you're taking a live look at the opening bell at the New York Stock Exchange. Allied Gold ringing the opening bell. And you've got Caris Life Sciences ringing the opening bell at the NASDAQ. Yeah, press the button there, you get some funfetti rain down on your head. Take a look at the Dow Jones Industrial Average. We begin the day flat, just barely to the upside right now. We'll keep close tabs on that. We could be due for some hyper waffling, just as you're seeing oscillation in and out of gains and losses here out the gate. Let's populate this, put this on a 3 trailing session look here. Over the past 3 days, well, yeah, we're about flat there too. So we'll keep close tabs on that one as we move on throughout the rest of today's session. Taking a look at the NASDAQ composite out the gate, you're seeing some fractional gains here to the tune of about 0.1%. Past 3 days, still net higher by about 0.7%. And the S&P 500, you're seeing that as of right now, it's up by about 0.1% here. So still, markets really trying to digest and evaluate, especially given some of those red candlesticks lower that we saw in the back half of yesterday's trading activity, as it seems like there could be more escalation if there was with the conflict in the Middle East, an entrance by the U.S. as President Trump had taken to social media to express some type of thought process around here. Ultimately, markets sitting on the edge of their ergonomic chairs or sprinting around on the trading floor trying to figure out how to best assess some of those social media posts here and what to make of the trade surrounding that as well. Also here, want to take a look at the sector activity here as we always do. We'll get back to the NASDAQ 100 in a moment here, but taking a look at the sector activity, we are seeing more gainers than laggards right now. You're seeing XLV, healthcare, that's pulling up the caboose as of this point in time out the gate this morning, down by about 0.5%. And then additionally here, taking a look at energy. We've been keeping close tabs on this throughout the week. Let me just give you some context over the past 5 days, 5 sessions of how we've seen this moving, especially given some of the oil price inputs that will affect the energy sector here. XLE up by about 3.25% over that period of time, and really tied to some of the price fluctuations that we've seen for Brent and WTI. Also, want to take a quick look at the NASDAQ 100, the tech-heavy average right now. You're seeing a pretty good mix here of players on the day, almost splits. We'll take a quick look at ticker symbol SIRI. SIRI, of course, Sirius XM. I'm sorry if I set off anybody's Siri on their phones or wherever your devices are in your home. But taking a look at today's move, it's down by about 1.5%. Marvell, and we'll dive into this in just a little bit more, but Marvell Technologies catching a bit here out the gate this morning. The company making some very strategic announcements here, and we'll see what more they have to say, especially as it seems like there is more of the inclination to communicate to the street the outlook as related to its own technological advancements here. And then additionally, MongoDB, Datadog rounding out some of the gainers here for the NASDAQ 100, and they're moving around quickly, so we won't try and click too many of them. Lastly, the Dow 30, as of right now, looks like you're seeing a little bit more red than green. JP Morgan, that's in the top spot. It's higher by about 0.9%, and Merck bringing up the caboose. That kind of mirrors what we had seen in healthcare being the biggest laggard on a sector basis out of the gate here this morning. It is time for today's strategy session. U.S. stocks, they have been powering towards record highs despite escalating geopolitical tensions and an uncertain rate outlook here. So the big question is, can the rally continue and break through some of those highs seen earlier this year? And what are the headwinds and tailwinds to watch for? Joining me now, we've got Michael O'Rourke, who is the Jones Trading Chief Market Strategist. Michael, always a pleasure to grab some time with you here. What do you think it takes for us to ultimately get back to and through some of those highs set earlier on this year?
Well, I mean, the market's acted very well ever since the president, pretty much reversed course on a number of the tariffs. So I think we're a couple of percent away from those all-time highs. Obviously, if the president continued to reverse course on tariffs and continue to move away from those policies, I think the market would break out. But it's also pretty expensive historically. So just with the uncertainty we have out there right now, I wouldn't say it's an attractive time to chase this rally.
With that in mind, it brings up the question, is this going to be a hot trading summer, or is it kind of a range-bound summer from what we should anticipate?
I think it's probably more of the latter. I think you bring up a good point there. I mean, we're looking at an environment where it seems like we're seeing the job market starting to show some weakness. According to news reports this morning, we might be getting more tariffs in the next couple of weeks. So, and obviously the conflict in the Middle East, there's a lot of uncertainty. I think a lot of the strength of the market has been that a lot of institutional investors are more defensively positioned at this point in time. So you have this wall of worry out there that's helping stocks levitate or, trade up at the higher end of the range. But I wouldn't say there's a real conviction out there. So I'd expect this summer to see a little more backing and filling and just more consolidation.
Where does the Fed, where does the Fed sit within that expectation for how we could see traders really evaluating a mix of major headlines that could be crossing both on the trade front and then additionally on the Middle East conflict front, depending upon if President Trump does decide to follow through with some of the posts that he was putting across social media about the U.S.'s potential involvement?
Well, to your point, President Trump is driving policy in this country on just about every level right now, and the fact of the matter is the Fed has no special insight as to what the president's going to do, so they're kind of stuck in this holding pattern for the time being. There is an expectation that they'll cut rates the second half of this year, and we're approaching that, so that seemed to be a positive. But also, we're going to expect to have a new Fed chairman, come next May, and we'd expect that would be someone with a much more dovish outlook. So the markets are expecting lower interest rates 11, 12 months from now. So that optimism is also partially on the tape. But as far as the Fed meeting today, I think all they can do is revise their forecast based on the data we've received. Like I said, they won't have any special insight as to what the president plans to do going forward. Okay,
want to give investors and viewers out there some actionable insights, especially with regard to how they can position themselves with both a Fed meeting that is going to conclude today and ultimately a decision where investors don't want to be caught off guard, perhaps fighting the Fed, but best anticipating the Fed and future meetings as well, plus the confluence of the events that we were mentioning a moment ago. What are your favorite parts of the market right now that are kind of key to your thesis?
So I think one of the problems with the market and the S&P 500 is that Mag 7 group is still pretty expensive. They've had a tremendous rebound, but what that has done is push down valuations elsewhere. So the small and mid cap space are attractive. Of course, they'll benefit from rate cuts down the line. Treasury bonds are attractive right now. Obviously, it would be nice to see Congress get the budget situation under control and get the spending under control. But still, a 4.5% 10-year yield is pretty attractive. So there are places in this market that you want to invest. And I think you just avoid the S&P 500, especially those mega cap names. But like I said, the great thing about those names is they're pushing valuations in other names lower. And the other thing I look forward to is if we do get another round of tariffs, whether it's semiconductors or pharmaceuticals, I would think that should, create a correction in those groups that should create some nice valuations among individual net members within those sectors. But obviously, we'll have to see how that plays out.
Really interesting. Michael, always a pleasure to see you, get some insights. Thank you.
Thank you.
Let's get to 3 market movers you need to watch for the trading day. Yahoo Finance's Jared Blickery has more.
Thank you, Brad. We've got markets kind of calm. There's an old saying, FOMC drift, and I think that's kind of what we're all waiting for, is the Fed later this afternoon. So the majors are pretty quiet right now, but I'm also taking a look at some of the winners and losers so far in the month of June. And then we've got some interesting developments in commodities land, so we'll take a look at that in a minute. But first, I want to start off with the sector action for today. Interesting, tech had been leading in the early goings, but not right now once the market is opened. But I do want to chart what's going on behind me in XLK. And I'm going to show you a 1-year chart so you can see the highs that we just barely took out over the past few days. So the tech sector has been putting in record highs for a couple of days now, but basically has just matched these. And what we might need to do here is take a little bit of a pause. We could see a handle develop. It depends on what happens this afternoon and a whole host of other factors, especially as a lot of the data comes in. And I expect to hear a lot from Powell this afternoon on his data dependency. So bottom line is we're looking for another catalyst there. And then looking at some of the leaders here, I was noticing that China is lagging today. ARK had been a leader, so disruption was leading early on, but not so much anymore. But this is China over the last year. And you can see since last September, that's when they launched their Bazooka QE, we've seen a bunch of sideways trading action. And right now we're just consolidating. So I have to think that there's probably more volatility ahead. And the fact that they're lagging today doesn't mean that much in terms of that ultimate direction, but just understand that we could see a lot more movement in China in the coming days and weeks. And then I want to skip back to the VIX for a second because that is holding above the 20 level. This is a year-to-date chart, and you can see it's well off of these highs here, but it has inflected up ever so slightly. So that means volatility is slightly on the rise, and that's something that we want to consider. And then we're going to take a look at some of the winners and losers here. So here are the top. It's interesting. So let's take a look at some of the bottom in July, and I'll put this on a trailing 1 month basis. You can see Tesla there, down 8.3% over the trailing month. That is the biggest of these, but there are some broad themes going on here. In particular, staples and beverage. We're seeing a lot of those stocks dip, and some names there, Brown-Forman, the whiskey trade, Constellation is also down. And then you have some solar names like Enphase and also First Solar. Those are down as well. And finally, utilities taking a little bit of a backseat here. So PG&E and Edison are two of the laggards that we're seeing. I want to wrap back up with the futures market and a couple of winners here. We're seeing industrial metals surge, and this is still on a 1 month. I'm going to dial this back to a 1 day. Platinum is back near 4-year highs. It took a pretty big dip over the last few days, and then it rebounded very strongly. Here's a 1-year chart that I like to show. Big breakout there. Silver dipping, but it just hit a 13-year high. So not a lot of action in silver right now, but it did manage to make that new nominal high. And then we're also seeing platinum. We just covered that. And then I want to close with crude oil, because crude oil has really been the bellwether and also kind of an indicator of all the geopolitical situation as those have been developing. That is up 83 basis points. Here is the 1-year chart. I'm going to dial this down to a year to date. We had consolidated for a while and we broke into the upside. 75 was a big level. We were just at 65 about a week ago. Now that we're at 75, this opens up some new possibilities, and crude oil is what you want to watch in terms of global demand, but also geopolitics. And I'm going to wrap there and send it back to you, Brad.
Thanks so much, Jared, setting up the trading day perfectly here. Appreciate it. Coming up, ways to play the AI trade beyond the Magnificent Seven, and why it could be a hedge against volatility. That's on the other side. According to the Bank of America Global Fund Manager Survey, long Mag 7 is one of the most crowded trades on Wall Street. But my next guest has some alternative ways to play artificial intelligence. I want to bring in Dan Newman, who is the Futurum CEO. Great to have you here back in studio with us.
Hey, Brad, good to see you.
So let's talk about this, because a lot of people have already piled into Mag 7, but you believe that there are other places that are non-Mag 7 that they could find some exposure to generative AI and this broader kind of thesis that's driven the market for the past 2 years.
Yeah, I mean, there's been nothing that is, deemed more attention than AI. You've seen just the news in the last couple of days, whether it's Microsoft Meta offering hundreds of millions of dollars to potential researchers to join their AI talent team. Or, you saw Marvell came out yesterday with a custom AI silicon roadmap, and their stock is popping. We could probably talk a little bit about that. But you're seeing it really across the board. And then, of course, so many people have kind of felt like, well, did I miss NVIDIA? And so the question I get asked most by clients, by retail investors, and why we basically launched the Futurum AI 15, which is the extended list beyond, is what else is out there besides maybe NVIDIA, Microsoft, and Meta? What are the plays, And so you hear about kind of what are the difference makers. So for instance, companies like Avago, Broadcom.
Right.
There's a $500 billion TAM, we believe, in the next 4 years for custom AI silicon. NVIDIA is going to get a lot of that. NVIDIA gets 92% of that market right now, we believe.
Right.
but they're not going to keep 92% in our opinion. They're probably going to fall to maybe 80%, 70%. So it still means NVIDIA, by the way, can triple to 300 billion. There's going to be 100 billion that's going to go into custom. And so we have Avago, for instance, as our number 2 name to play, because that $100 billion opportunity, that sits with the Google custom chips they're doing. It sits with custom chips that companies like OpenAI are planning to do. So that's one of the plays. Of course, you've seen, Brad, TSMC. TSMC, people think about it as a foundry, and of course it's a very big name, and there's a lot of dollars invested in it right now, but people don't always make that connection that whether it's NVIDIA making chips, Meta making chips, Microsoft and Amazon doing their custom chips, all of them are dependent right now on TSMC. And as much as I think the US needs a strong Intel, we aren't there yet. So right now, TSMC has all the pricing power, so it sits at the very top of our list. And then there's some eclectic names. I'll pause here, but basically there's eclectic names like Oracle that we put on there. You saw what a pop they've gotten, but they've absolutely nailed this AI transformation, and they are in a perfect position. And just yesterday, xAI and Oracle made a big announcement together that they're going to be using Oracle's infrastructure to train xAI models.
Right. So even within that, and I'm glad you brought up Oracle, because that's where I wanted to go next, especially as we were looking at the board there a moment ago with, I believe it was Oracle, we had Salesforce on there, I think Snowflake was on there as well. There we go, for our viewers. And I'm bringing them up because all of them are talking about agentic AI and what that can mean for their businesses, but also, as Deloitte is talking about it, what it can mean for specific industries. I believe Deloitte came out this morning and projected it could be $150 billion for the telecom industry alone. So for all of what we're hearing around agentic AI, who are kind of the top picks around that as the non-Mag 7, but top 15 of your kind of viewpoint within that specific kind of subsector within this AI play right now?
Yeah, so you saw Oracle on there, and that, of course, we hit on that one. They will do agents on top of their software database stacks. They've done very well in that space. Salesforce is a name that comes up, and we really like it. Now, it's controversial, because there are some people that kind of think the SaaS play is at risk. Satya Nadella came out and called SaaS basically deprecated CRUD databases with logic on top of them. And by the way, he was saying that in respect to their own software, they have a whole SaaS offering in business in their Dynamics suite. So he was actually, sometimes being able to disrupt yourself first is a really critical moment. We see this in every industry right now. But Salesforce has this really deeply entrenched user base of its CRM. Huge customer base. And we believe that a lot of companies are going to maybe look at those customer service workflows first, marketing workflows first, and sales workflows where an agent can do customer outreach. It can do follow-up. It can recommend to a sales team what's the next best action to keep a deal in progress. So things like that are why companies like Salesforce made it onto our list, because we think those are the agent use cases that are going to drive immediate efficiency and productivity. And by the way, $150 billion for telcos conservative. I mean, we see a $20 trillion productivity gain by the end of the decade, and we see something like $5 to $6 trillion of cost takeouts. Now, this goes back to the Amazon comments that came yesterday from CEO Andy Jassy talking about jobs and the impact. I mean, it's coming for jobs on both ends. It's coming in robotics in the warehouse. It's also coming for those knowledge worker jobs. So agents will bring efficiency first, prune to grow.
One of the other areas as well, and this is one of the kind of top spots that we know our viewers are hitting when it comes to the private market data on Yahoo Finance, it's OpenAI. And the speed with which they're not only able to garner some of the investments from publicly traded companies that we're talking about here now, but also government contracts, which is a new effort for them going forward. What's the significance of them being able to hit some of these milestones in stride, and what that means for the rest of the publicly market and publicly traded entities right now in the market?
Well, I mean, I know we are in this conflict moment with Iran, Israel, and the U.S. kind of sitting on the edge of it and potentially coming in. And this, of course, brings a lot of attention to defense. I talked about how AI is a defense and a growth trade. If you look at its deflationary impacts and you look at companies like Palantir that sits at number 3 on our AI 15 list, is because they have this unique ability to contract the government, and we all know how much defense spending can impact the success of a tech company. Oracle was another one that did very well in that particular era. So we go back to OpenAI, and OpenAI is saying, hey, here's a massive TAM for us to explore. We are seen as the world's leading researcher in AI. We could potentially partner with other private market companies like Anduril. We've seen there's been some opportunities for those kinds of partnerships to build something that the government can benefit from. But just Palantir alone and the way the market has responded to the conflict. and the stock keeps going up. Growth usually takes a hit, Brad, when the markets are worried about us going to war. The market has been incredibly resilient, and a lot of these growth and AI names that we see, again, I keep mentioning Oracle, but Oracle, Palantir, Avago, they're seeing growth and they're going up. And just yesterday, the Marvell note, which isn't on our 15, but with that $100 billion TAM for custom chips, you're seeing that the market sees massive opportunity. And of course, the defense sector is going to continue to spend big, and AI will accelerate the innovation in that area.
You might have to expand that 15 to AI Sweet 16. Dan, thanks so much for having us here. Thanks so much for joining here with us in studio. Coming up, everyone, oil prices retreat from their recent highs. We're breaking down what's behind the moves. That's next. Oil prices in flux as the conflict between Israel and Iran enters its 6th day. President Trump's call for Iran's unconditional surrender, suggesting potential U.S. military intervention in the conflict. Yahoo Finance's Inez Ferre has more on what this means for energy prices. Inez.
Brad, well, oil is right now up more than 10% from the outbreak of the Israel-Iran conflict last week. So just pulling up a 6-day chart, you'll see that it's up 11%. Brent crude also up around 11% during that time period. And this is without any visible loss of Iranian supply yet. So the question really is, will prices go higher, and for how long? And if the fighting escalates further? JP Morgan analysts said in a note today that if history is any guide, oil shocks from conflicts tend to be pretty short-lived. However, that's what we've heard from other analysts also immediately after that outbreak. But the bigger risk, however, is prices could go higher for longer if there is a regime change in an oil-producing country like Iran, which Iran produces more than 3 million barrels of oil per day. And that's where analysts are saying that you could see higher oil prices sustained over extended periods, because regime changes tend to have a profound impact on the country's oil policy, production, and global prices. Now, there's been a lot of talk about the Strait of Hormuz, and analysts believe that the probability of that closure is very small if Iran were to close out this Strait of Hormuz. This is where more than 20 million barrels of oil products per day flow through here. But I will tell you that tanker costs in the entire Middle East region have jumped. Torm, one of the biggest operators in the world, told us that tanker costs are roughly between 40 and 50% higher than they were a week ago, all based on increased demand, Brad.
All right, Inez, thank you so much. Appreciate it. Everyone, that does it for the Morning Brief. Join me in the next hour for more on Catalysts.